Hey there and welcome. If you've ever found yourself staring at your savings wondering how to make a truly logical choice between the safety of government bonds and the higher yields of corporate bonds, well, you are in exactly the right place. That's what we're going to break down today.
It's the classic dilemma, isn't it? I mean, you've worked hard for your money, so of course you want to protect it. But at the same time, you want that money to work for you, to actually grow. So how do you walk that tightrope between security and opportunity?
So, here's how we're going to tackle this. We'll start with the investor's dilemma, then we'll meet the two main players, the bonds themselves. We'll get into risk versus return, then we'll hit that big aha moment with risk compensation, and finally, we'll talk about how to make the logical choice.
All right, first up, let's dive into that fundamental tension that pretty much every investor feels. It really is this constant tug of war between wanting to keep your money safe and the ambition to see it grow into something more. You know, on one hand, there's that powerful primal instinct for preservation, just to protect what you've earned. But on the other, there's that exciting desire for growth, right? The hope of making your assets more productive. This is the core conflict we're here to figure out. Okay, so to really dig into this dilemma, let's meet the two main players on the field, government bonds and corporate bonds. And this lays it all out perfectly. So over here, you've got government bonds. They're issued by a country, so they're considered super low risk. They're backed by the full faith and credit of the government. The catch, of course, is that the yield, your return, is typically lower. And then over on this side, corporate bonds. Issued by a company, the risk level can be all over the map, but to get you to take on that uncertainty, they have to offer a higher potential yield. I love this analogy because it just nails it. Think about it. Lending money to the government? That's like giving a loan to your super reliable uncle who always pays you back. But lending to a company, that's more like you're promising maybe a little unpredictable cousin. They'll pay you more for the trust for taking that chance. Okay, let's get into the nuts and bolts here. Because to make a truly logical choice, we have to be absolutely crystal clear on the two things that drive this whole decision: risk and return.
So first up, yield. This is a pretty simple concept, really. It's your paycheck for lending out your money. Think of it as the reward part of the equation, what you get for making your money available to someone else.
And on the other side of that coin is default risk. And this is the big fear for any bond investor. It's the chance, no matter how small, that the borrower just won't be able to pay you back. This is the risk part of the equation we keep talking about.
And this all leads to a fundamental rule of investing, one you just can't get around. To get a higher potential reward, you almost always have to accept a higher potential risk. You just can't have one without the other.
And this chart, it shows you that rule in action perfectly. See, government bonds are sitting right here in the low-risk, low-yield zone. Corporate bonds, they're further out here on both axes. You're taking on more risk, for sure, but you're being offered a higher potential yield in return. It's a direct trade-off. Okay. This brings us to the real aha moment of this whole thing. This is the idea that's going to help you level up your thinking beyond just safer is better. So this is the big question, right? Given that trade-off we've been talking about, how on earth do you make a logical choice instead of just running to whatever feels safest by default? Well, here's the answer. It's a way of thinking called risk-compensated return. And don't worry, forget about any complex math for a second. At its heart, it's just a really simple but powerful question. Is the extra yield I'm being offered actually worth the extra risk I'm taking on? You can actually think of this as a quick three-step logic check. Step 1, what's the extra yield? How much more are you getting from that corporate bond? Step 2, assess the extra risk. You know, what's the company's financial health like? What's its credit rating? And finally, step 3, you decide, does that extra reward really justify taking on that extra risk? All right, let's pull all of this together. Because when you start applying this logic, you completely change how you make these decisions. You're not just looking for what's safer, you're looking for what's smarter. And this is the most important thing to remember. See, the goal isn't just to find the safest thing out there. The goal of a smart investor is to find the investment that offers the best return for the specific level of risk it carries. It's a subtle, but wow, what a powerful shift in perspective. So I'll leave you with this one question to think about. Take a look at your own investments. Is your portfolio just built to be safe, or is it built to be smart? To make sure you're being fairly and adequately compensated for every single bit of risk you take on. It's something to think about. Thanks for joining me.